this zone, as we all know, as supply zone, to close all their position, or we call it mitigation before continuing price to the downside. And this is how we take advantage of this move, because we know price will always come back to this demand zone to mitigate. So that's where we always look for buys. Like this, price will always come back to the supply zone, so we look for sells. So now let's see a few examples of what a supply and demand zone looks like. So as you can see, and I forgot to mention, the key point of a supply and demand zone is breaking structure. If price doesn't break structure, our supply and demand zones are not valid. You'll see in a while. What does that mean? So as you can see, price is trending bearish, broke structure to the downside. This leaves the supply zone. So price came back, mitigate, and then moves to the downside. And what I mean by capturing liquidity, there's a lot of trendline liquidity being created. Price capture all these liquidities before moving price to the downside. So price came to mitigate and continue to the downside. Now, price is bullish, broke structure to the downside. As we all know, leave a supply zone. Price came back to the supply zone, mitigate, and move down. Now, you are bullish. Price broke structure to the upside. Last demand zone that broke structure. Price came back to its demand zone, mitigate, continue to the upside. Now, as you can see, we are very bearish, and over here price broke structure. I know right now there's multiple demand zone. There's a bunch of last down move before the up move, and basically a demand zone is in an easier term is always the last down move before the up move, or for supply zone is the last up move before the down move. So as you can know, this is all demand zones. Price came back to mitigate and move up. I know there's multiple demand zones over here, but later we're going to talk about refining and premium discounting pricing to find the best demand zone, the higher probability demand zone. There's no best, it's higher probability demand zone. So as we all know, price is bullish, broke structure to the downside, supply zone left behind, price mitigate that supply zone and continue to the downside. Same thing over here, price is bearish, last down move before the up move, broke structure, price came back, mitigate, and continue to the upside. Same thing on and on. Price is bullish, right over here, it broke structure, supply zone created, price came back to the supply zone, mitigate, and move to the downside. Same thing, price is bullish, price broke structure, last down move before the up move, capturing all this liquidity, price came back to this demand zone, mitigate, and continue to the upside. Now, let's talk about refining a supply zone. So, what is refining a supply zone means? So, basically, refining a supply zone means finding a much more smaller supply and demand zones in lower time frame. So, why do we do that? So, basically, do that to get a precise entry, to reduce our stop loss size, and to drastically improve our risk reward ratio. So, what does that mean? So, basically, we have a demand zone created over here. As you all know, the last down move, last red candle before before the upside, and we have a demand zone over here. Now, if we go to lower time frame, we can find much more smaller demand zones, much more smaller candles. And why do we take those candles? Why do we refine to those candles? So now we will see why. So if you place an order over here, we're going to have a much more bigger stop loss. Now risk to reward is pretty low. We don't take risk to reward like this. But just imagine if we refine our supply and demand zones. You get a much more tighter stop loss, a much more higher risk to reward ratio, as you can see. Usually it's not this low. We usually aim for 1 to 3 and above with supply and demand zones. So this is why we usually refine our supply and demand zone. Now, so let's look at some examples. So as you can see, let's see. So we have the last down move before the up move that broke structure. Remember that a demand zone is always the last down move before the big up move that broke structure. For supply zone is always the last up move before the big down move that breaks structure. Remember, they always has to break structure. So this is the last down move before the break of structure. And now price came back to mitigate and move up. So now if you just imagine, if you take a buy over here, aiming all the way up here, you have a 1.92. Just imagine you went to lower time frames and refine this demand zone. So we go down, You can see, this is the last down move, much more smaller zone, and now we got a refined entry. So if you take this demand zone, we have almost a 1 to 3 compared to a 1 to 2. You see, this is an example of how to get a higher risk to reward ratio. Same thing over here. We have a last down move before the up move that breaks structure. And then now this zone is too big. It's literally so big. Let's imagine we are aiming for these highs over here. It's a 1 to 1.24 risk to reward ratio, which is very, very low. And it's not a good risk to reward ratio. If you go to lower time frames, we can literally refine the zone to much more smaller zones. As you can see, we got two zones, two valid zones. Let me see if I can find the last down move. I think it's the 1 hour time frame. There you go. So let's see. As you can see, we have two zones over here that we can look for buys. And price came back. This is where we'll look for confirmation, which we will learn in the next lessons. So now let's say we refine this zone to this last down move for the up move. And look at your risk to reward. It's almost a 1 to 8.56. It's almost a 1 to 9 risk to reward ratio compared to 1.25 risk to reward ratio.